I want you to do this conceptualization, very strategic diagram which connects numbers with underlying internal control systems. So I start with financial statements, right? And you can do with me. In financial statements, I have this rectangle for a purpose. Later you will know what this is, right? And also I will describe that set of financial statements will have 5 things, not 6, right? So what are these elements, right? 1, 2, 3 here and other 2 here. And this is what financial statement means. What are they? Asset, liability, equity, income and expenses. So everything in financial statements can be explained through these elements of financial statements. Then for the purpose of this subject, we will further break it down that, you know, financial statements will have 3 things which are more pertinent from anybody's perspective, especially from audit perspective. They are very, very important. And what are those 3 areas? One is transaction. So the full name should be classes of transaction, but I write transaction. Then account balances. So I just write AB to make use of the space much better. So AB means account balances and disclosures. So if you take financial statements, you know, anything can be classified under these 3. And those are connected to these 5. But this anybody will know. But we are interested in something much bigger than this and what it is. So that is, I want to write that in a different color because that's the most critical thing for you to learn, right? So when you analyze set of financial statements, you are using this framework. Or when management prepare financial statements, they use assertions. Remember, in few minutes before in my introductory video, I mentioned to you accounting standards together with this auditor's methodology of identifying what can go wrong in any account balance, say PPE or financial instrument, any of that you will analyze using assertions. So what these assertions? So all the assertions I bucket under this term called pack cover. Pack cover, right? So I will explain to you and leave some little space here to write the meaning of each. But remember, below also we need to have sufficient space to explain much bigger concept. So red color in this diagram I am using only to write some most critical things. Risk of material misstatement. So the first question to ask, what is a risk of material misstatement? It relates to an assertion and then it relates to transaction, account balance or disclosure. For example, property, plant and equipment valuation, right? Whether valuation is misstated or not, how do we know? So that is the understanding of material misstatement. So I want you to write few notes under each of these. So you can put a strict mark 1 and describe somewhere. I go outside this diagram to write what RMM means. And if you open and also remember, now if you want to really connect as you study this diagram to your study text, auditing standard book, you are free to do. So first thing I want you to know what RMM is. So star 1 talks about RMM. So very easy. RMM is a difference between 2 things. Now I want you to guess difference between what? End of the day, you are auditing company set of accounts. So the balance as per company's policy, right? I write the word based on the company's policy. the recorded balance. Let's say this is PPE 100 million. So this is the recorded balance, and again I am using red color because that's something very, very important. The difference between recorded balance and the balance that should be recorded based on the SLFRSs, right, or related LKSs, right. So which means if you apply property, plant and equipment LKS and even a related LKS, because see in this case you will notice that this is a manufacturing company, and also I am giving you some hint now. See, if you convert this explanation to a case study, so there is a company in Sri Lanka, you know, some manufacturing company that relies on import and export of you know, certain equipments, let's say kind of any business you can assume. Let's say this company is manufacturing stainless equipment, you know, kitchen equipment, etc. Now the whole import has stopped and there are a lot of other issues. The demand has come down. You know, there are manufacturing plants, some machineries are not in use for longer period. That is a risk. So in this explanation I'll connect from where risk comes, but for the time being, if there is such risk, the LKS 36, right, impairment, because these assets are now not in use, there is a possibility that these assets to be impaired, you know, based on the SLFRSs. If you apply SLFRSs, special impairment, now this carrying value need to be written down to 80 million, and this 20 million is a misstatement. If I say this 20 million is 10% of the profit before tax, then I am pointing out to another important concept, which I go back here and link to M, and that M is another syllabus topic that you need to be aware, and that is called materiality, right? It is material. That is material, right? Now see my simple example that I took one account balance, one assertion which is valuation, and then I interpreted what is a misstatement. The misstatement is a difference between the figure recorded by the company and the figure that should be recorded by applying the relevant accounting standard, and we found this company has not done the asset impairment and the misstatement is 20 million. Then I said 20 million is 10% of PBT and it is material. If I change this and say that the impact is 1% of profit before tax, then I will say this is not material. Now you are understanding what is materiality, which you must know in your syllabus, right? So materiality means if there is a misstatement, it is going to, now here material misstatement means if there is a misstatement, it's going to affect, the key word is economic decision of the primary financial statement users. Now that is a different word. Now that's the latest definition of materiality, right? If there is an omission means something not included in the account. Say disclosure is omitted, that's called omission. Or if there is a misstatement, in my example this is a misstatement. If that's going to affect the economic decision of primary financial statement users. Now if you look up the dictionary and see what assertion means, it says assert as a verb means declare something to be true. That means you are telling, you know, he as company CEO asserted that this year employee satisfaction has gone up. How do we know satisfaction has gone up or not? We don't know. It is a statement only, and that is an assertion, right? That is a general meaning. But remember, in financial reporting, assertion has a specific meaning. Please write down, right? In your note 2, like I said, I may erase this part, but better you keep your note. Note 2, assertion means what? The key word is representation by management. representation by management, right, which are sometimes which are explicit, which means it is directly shown in the accounts, right, or it may be even implicit, right, but it is embodied, it's part and parcel of financial statement. So I only highlight one word, representation by management, which means when management prepare financial statements, when they say property, plant and equipment is 100 million, they are saying all of this, and I want your careful attention to this. What they say is, number one, look here, all these 100 million asset, they are in existence. You can come and see they are there. That's existence. And this value of 100 million is valued properly based on the SLFRS. The depreciation is right, impairment is right, revaluation is accounted for properly, and that is valuation. And at the same time, company has not recorded anything which they don't have a right or obligation. Now this is an interesting point. If you apply latest accounting standard, latest thought process of lease assets, now it may not be there in the asset, it may not be in the balance sheet as an asset, but if you apply leasing standard, what is the key word? Now these words are very, very important. This is the beauty, this subject connecting to financial statement. Now let's say there is a land we are using for 20 years, right, a longer period of time. This is not in your balance sheet, but now if you apply SLFRS new standard, the definition of lease, the right to use model for 20 years, right, although you are not the owner, it will come to balance sheet because you have the right. So new definition of asset in the conceptual framework, it describes asset as right for economic resources. Again, assertion definition, let me to complete. Assertions are representation made by management. This is a representation, is just one word, but remember, assertions are used for three things in financial reporting. What are those three things in any financial reporting purpose? Recognition, measurement, and disclosure. So these are based on the assertion. So based on the assertion, there are three things. So now I am connecting another big thing to this diagram, right, and I'll come back to assertion again. What is that big thing? These financial statements are to be prepared based on FRF, Financial Reporting Framework. Now again, for your knowledge, remember there are two FRF, and this diagram is going to be very, very powerful, strategic one. And in about 20-30 minutes, you can see this is clouded with lot of concepts, right? So FRF has, what are the types of FRF? Now, do you know what is a fair presentation framework? Fair presentation, and the other one is a compliance framework. So FRF can be either fair presentation or compliance framework, right? So sometimes you didn't understand what I said, doesn't matter, I'll explain to you in a minute. So then, now like I said, the assertions are used. Even I can write assertion here again. Assertions are used. So assertion is like, characteristics of these account balances, but that determine true and fair view. That's the very powerful word. Again, remember, if there is a risk of misstatement, you may want to read the meaning of this assertion. Let me to take 5 minutes and explain to you. Please write with me. So I am not writing these words here, so it is going to clutter my diagram. So I want you to make, in small letter, presentation, accuracy, classification, cutoff. So that I will write cutoff, right? O for what? Occurrence. V for what? Valuation. E, again, where here we will write V and A, right? Valuation and allocation. Allocation means things like depreciation, right? Impairment. In some assets we make an allocation. Valuation, allocation. R means right, O means obligation. So did you write that down? So the next thing which you can go back to, that's why I said I will erase some of this, and I want to explain to you. If you want, you can put example 3 to understand what assertion means, right? So I will use this space, take an example, quick example, so that you understand what assertion means, right? Say this is an export company, right? And we are talking about revenue recognition, and SLFRS 15, 5 steps process of revenue recognition, performance obligation, all of that. You understand that, right? Because without FRF, revenue recognition standard, we can't talk about any of these assertions. So therefore you should understand 5 steps process of revenue recognition, right? So starting from the contract, right? So identifying performance obligation, determining the price, allocation, identifying point at which revenue is recognized. Is it at a point when the control is passed? See the word control, earlier regime is risk. Now new standard talks about what point control is passed, right? And then is it over a period or at a point, right? So all of that you have to look at. But I take a simple example of a company. Now this company is exporting goods. Now I took an example earlier. Say this company is manufacturing some kitchen equipment, stainless stuff, and they are exporting, and usually Incoterms. Now that's the important word, Incoterm. If you Google, Incoterm means international commercial terms. There are various terms like FOB contract, FCA contract, right? Now if you take FOB contract, what is FOB? Free on board? When the goods are, right, on the vessel. Now if I draw a vessel here, when the goods are on the vessel, then only you can recognize the revenue. But if you take a FCA contract, when goods are handed over to a forwarder who will eventually hand over to, and now see what is the contractual document here? BL. What is BL? Bill of lading. Right, so that's the official document issued saying that goods are on the vessel and it's handed over, it's ready to go, vessel is going to sail, right? So at that point you recognize revenue. Here when the goods are handed over. So my key point here, I want to explain to you some assertion here. Now if you take one company, right, and we find the case, I want to explain to you this assertion occurrence first of all. What is occurrence? Now you can write a note and you can also go through the book. And another thing I want to say, if this assertion definition, if you want to, all these are there in auditing standard book, right? In auditing standard book, right, the most of the topic that I am talking now is from one fundamental risk assessment auditing standard, which is auditing standard number 315. So you can write somewhere here, from auditing angle, how audit is evaluating the risk using 315 auditing standard. Sri Lanka auditing standard 315, and also in the version now Institute has issued 2020 auditing standard, which is the latest one. If you are having the old auditing standard, if you go to page number 315, coincidentally you have the assertion also in the same page, right? But now page number may be different in the new book. So what I want to say, in my example of export company, occurrence means, look at the definition of occurrence in the auditing standard or study text. Occurrence means this company has recorded a sale of, let's say there is a sale, right, which took place 31st March 2020. There is a sale amounting to 20 million, that's a major sales. Say, let's say this is in dollar now, functional currency is dollar. This is a major shipment that is 10 million US dollars, sizable one, right, significant one. But the date is 31st March 2020. So the point is, occurrence means recorded transaction has occurred. Now you better write that, right? Recorded transaction, has it actually occurred? Recorded transaction, right, occurred and relevant to the company. See, recorded transaction occurred. Now what does it mean? In the ledger, 10 million is recorded, but do we know has it occurred? At what point it occurs? Go back to SLFRS and ask at what point revenue is recognized. If this is a 4B contract, now right now company has recorded only based on the dispatch note. You know dispatch note, let's say invoice for the easiness, the record means in company's ERP system they have raised the invoice. That's it. But still goods are within the company's premises, it doesn't reach the vessel. So if you apply a 4B term, this transaction, although recorded, it has not occurred. It has not occurred. It has never occurred on 31st March. So what assertion is going to fail? Occurrence assertion failing. Right, again I am writing something here but which I will erase, which you can write, okay, I will write here itself, right. So I am writing two things here now. One is transaction, other one is account balance, right. So my transaction is sale and my balance is debtors, receivable. So I know occurrence assertion has not satisfied. There is no sale as at 31st March. And also I know if there is no sale, debtor is not in existence. Existence is not satisfied. And I also know that there is no right assertion also not satisfied, because company does not have right to recover that asset. Right, and also I know the fact that sale at 31st means this is a special day, because this is the last day of your financial statement, that 10 million is to be removed and it should ideally go to next financial year if this client year end is March. So therefore this not only occurrence, it is going to misstate cutoff assertion. Now you see how we connected to assertion. The cutoff is wrong. In this particular, if this is an exam question, this is the answer you will write. There is a misstatement of 10 million. You can also give, which is 10% of profit or whatever, you can indicate the size. There is a misstatement of 10 million because the revenue has been recognized, right, before the control is passed. And according to the contractual terms, which is a 4B, revenue should be recognized only when the goods are on the vessel and the company has recognized at the time of raising the invoice. Therefore, this transaction should be reversed. That's the answer in the exam. Very short answer. If you write more, you're wasting time. So now I explain to you few assertions. Through that explanation, occurrence done, existence done, right. All of that done. But I want to tell you one of the toughest assertion to audit is completeness. So I want you to write that meaning of completeness as well, because the completeness means so please write completeness means all transaction that should be recorded. All transaction should be recorded. That should be recorded have actually been recorded. See, imagine it's very tough to audit, right? Now, how do you know now what should be recorded? What they have reported, we have say 900 million revenue they have reported, right? Now, we don't know this is what should be recorded because this 900 million is equal to invoice. But if we now know their point of recognition of revenue is not only invoice, we have to look at the shipping details. You may have to do a reconciliation. Now see that word later, I will explain to you, reconciliation. The reconciliation becomes a control. That's a very big point that I highlighted. Now, if you don't have a reconciliation, reconciliation is an internal control. So internal controls are critical when we analyze RMM. So if there is no reconciliation, what will happen? We don't know whether this 900 million represent the goods that have actually been shipped based on the BLL date. So that is a tough assertion. All transactions that should be recorded have actually been recorded. So with that, I have covered completeness. Accuracy is very easy. Accuracy means accurate, arithmetical accuracy. Presentation is understood. So all these assertions, I have classification is very easy. So all the assertions now you have understanding. But now again you spend your own time. This is I talk. You talk to you and understand whether you understood it. That's how best students do, because you have to internalize what I say. So basically, with that I cover my explanation on assertion, right? I have to come back to my main analysis of telling you the story of this subject, like a story how it evolves. So I removed this additional explanation from the diagram. Right, so now I can come back and explain to you, because I gave you a few examples, it's easy for me to take on. So now what I am going to do is I will draw this circle. I will draw this circle around the financial statement, and that is a very big concept in your syllabus, this circle, because the idea is circle is around the financial statements, like protecting the financial statements, and the meaning of the circle we will discuss. And I want to also tell you, now we can go into much detail of this RMM. So therefore, I am taking out, I am going to explain to you, my next explanation is what are the two elements of risk of material misstatement. RMM, the first aspect is inherent risk. Again, very, very important for you to understand what IR is. IR, inherent risk. So I am bringing, so I am also writing here this term so that you remember this. IR can be explained in using two C's, right? Two cums, because I am going to put here two C's, 2, 3, 4, 5 characteristics of an inherent risk. 2, 3, 4, 5. In the exam, this is like a picture. It will come to your mind by looking at a case study. Can this be an inherent risk, right? And it's also important that you understand what inherent risk is. Why I am now only explaining to you what an inherent risk is, I have covered assertion, right? So what I want to say, forget all the books. Now we say that it is an inherent problem, that when you are living close to the sea, that you are, your life at a risk. If tsunami or something comes, if you are in certain areas, flood is an inherent risk. Inherent, you can't avoid, it is there. It says susceptibility, looks like a big word. Susceptibility means possibility. Susceptibility that an assertion can be misstated. Now see, the definition you can't understand if you don't know what assertion means. Susceptibility that an assertion, right, can be misstated individually and collectively, right? That is the definition, without taking into account internal control. If you look at my previous example, that I said this company has to reconcile invoices. Invoice means invoice in the system. But whether goods have sailed on the vessel, we don't know without looking the bill of lading detail. So invoice and shipping detail reconciliation is the control. Now if you forget that control, is it inherently high in this company that sales can go wrong? Depends, you know, if that company is not having, we can't say inherent risk is very high, because this is a straightforward one, because you have to record the revenue by looking at the shipment details, right? But then if you put it in this way, this company has several contracts. Earlier I gave only example of FOB, but there are sales, some sales you have to apply FCA criteria. FCA means hand in over. This is not fellow chartered accountant, right? This FCA is a contract. When you hand over goods, this is goods on the vessel, right? And then there are CIF contract, you know, the goods has to reach, it including all inclusive, right? Now, there are different invoices, we don't know which one is applicable. Now, this is really complex. Now, I can come and write, I said here 2 C's, I will write 1 C is complex. That is wonderful. Complex, when there is an complexity, inherent risk is high. So, that's a very good example. Now, you can write this company has multiple contractual terms, as a result revenue recognition is complex, therefore misstated is an answer in the exam that you will write. So, that is one characteristic. Here 2 C's, complexity, right? The other C is change, and that is a very big word. Change, you know, change is a part of our life. Our life has significantly changed after Corona. You know, even businesses have started, people are working from the home, some businesses have disappeared, new business models have emerged. Now, these changes that have happened, the technology is changing. Now, if company is unable to change, that is the biggest risk company is facing. So, I am writing the biggest risk that company can have is if they are unable to change, and I want to write here most important concept more than financial. Now, we are going beyond the financial statements to talk about business risk, and I want you to put a strict mark here. Now, up to now we have written important note number 1, and I think we wrote about 2 notes. Note number 1, we are talking about risk of material misstatement. Note number 2 here about assertion. Our note number 3 is about business risk. And I will give you again page reference for business risk, which is a very important concept in your syllabus. Right, so I'll come to that and I'll give you that. Now, why I took that example suddenly, because remember, some of the business risks may lead to change, and that change will affect your account set. Now, let's say technology is changing. Now, if you don't upgrade with the latest technology, that is a change, and the business you will suffer because you are not changing the technology. Competitor has changed and grabbed the market share. That change is a business risk, and business risk means you will not achieve. Let me to write on the top what I will cover in a little while. Every business is there to achieve business objectives. Now, what I write on the top are very, very important. Every company has to achieve business objectives, and to achieve those objectives they need to have strategies. Now, this is where I go beyond financial statements to the bigger picture of the business in terms of business objectives and strategies. And remember, if there is any what? Now, let me write here these words. If there is any condition, right? Events like you can say corona or flood or whatever, right? Condition is a special situation that company's financial condition in doubt. If there is any conditions, events, action that the company is taking to close down a factory, or inaction is where company is not adopting the technology. If these condition, event, action, inaction is going to affect business objectives and strategies, that's called a business risk. So let me to give the page number, because this is examinable. I'll give you page number for business risk when I give overall page numbers. So, but I haven't explained this in detail to you, but I just build the connection that when there is a special financial tough condition, or an event that have happened like tsunami or corona or any government restriction, or that bad action that company is taking, that company is doing some unethical thing, or that the company is not changing, that is called inaction, that leads to a business risk, and that business risk is going to be a part of this inherent risk. So I was explaining to you inherent risk using 2 C's UMS. So I wrote here change, complexity, and what are the other words? What is U? Uncertainty, and then we have, what is M? Management bias. I am going to explain to you all of this. Management bias, and last one is subjectivity. And after this, after explaining this story, I'll go back to some slides and show you some practical example of inherent risk under each of these, so that you will understand. So already I took the example of revenue recognition here and explained to you complexity. Now what is uncertainty? Certain balances in financial statements, they are inherently imprecise. This word I want you to remember, and in this diagram whatever I am writing in red, they are critical, right? So I write this word MU. What is MU? In auditing there are 2 MUs. One is a material uncertainty, other one is a measurement uncertainty or estimation uncertainty. Now there are certain figures in set of accounts. For example, there is an investment in a private company. If you apply SLFRS 9 fair value model, because equity instruments are to be fair valued, there is no market price, you have to use your own valuation model, the answer is going to be subject to high inherent risks with the assumption that you are going to use in the particular model. That's measurement uncertainty. And management bias comes when management is under pressure. I am connecting this to FRF, and again I have written this in red color. Remember, whenever something red, that is examinable. The point is, management bias means, especially when there are tough time, I will explain this separately, management intentionally manipulate some of this for window dressing, right, to have a better picture. And again, subjectivity is due to the assumptions, subjective assumptions used. Again, this is very similar to this uncertainty point. This is mostly applicable for estimates and fair value. Auditor is much interested in estimates and fair value, because that is where management can change the assumptions and change the figure. Sometimes company change discounting rate by one figure and have a millions impact on the P&L. So that is subjective, right? And that leads also to uncertainty in the measurement. That is why auditor is auditing this specifically under 540. So now let me tell you one thing. This is circle is controlled, but I am going to break the circle here. Now circle is breaking and leaking. That leakage leads to a MM. What is MM? Here our MM, risk of material misstatement. What is breaking here? And what is the meaning of this? This new circle is control risk. And now you understood that risk of material misstatement has 2 aspects. One is the inherent risk. And why I said the circle is breaking, that if there is a control which is ineffectively, please write this word, design weakness. By design this control is failing, or that the control has not been implemented, or control is not working, which we call operating effectively. Now these all the words that I am writing on the board today, right, in this lecture will be useful when you are writing an answer. If you want to talk about internal control failure, you can always use these 3 words. But depends on the case study, right? Design means, now control is what? Is a control, right? Let's say you have your company is producing computer chips, mobile phones, smartphones like Apple, Samsung, Note 5, whatever. Much valuable smartphones is being packed, and there is a storeroom which is open. Now open means a fraud risk, somebody can come and take. Design means you lock the door, but the lock is anybody can break the lock. Very simple lock. By design, control cannot handle the risk. The implementation means you have a lock, but the door is not locked, so control is not implemented. Operating effectiveness means there is a good lock, but then if you randomly go and check, some days the door is open, it is not continuously working. So now let's forget that door example, take my revenue recognition example. Earlier I said this company's revenue recognition is tough, therefore there should be a reconciliation. What the reconciliation? We have to compare two things, invoice with shipping details. Now this is the reconciliation. Now shipping details has bill of lading number, handover number to the forwarder. Now you can easily match, for example, invoice done, bill of lading done, term is FOB, revenue recognition is done, right? Now if it is a FCA contract, you have another day. Now this date is invoice, this is invoice, this is bill of lading, and there is another day called handover. There is another shipment that is done, bill of lading is not raised but handed over, so revenue can be recognized. You know what I am trying to say? There is a reconciliation like this. Because of the reconciliation, revenue is right, but now we find that this particular accountant left because there was a dispute with the managing director. Managing director said, forget your accounting, I want every invoice to be booked as revenue, and he put some pressure and this guy went. Now that is a big threat. Imagine you have whatever fantastic system and capable accountants, managing director is going to ruin. Probably managing director must be in this circle. That's a big point that I want to tell you now. What is the circle then? These risks are inherent risks. These risks that we are talking now, I am actually with that example, I am expanding my explanation, right? This is called assertion level risk. So what is in red are very, very important. Assertion level risk, examinable, and this circle you can describe what is inside the circle, not the circle name. Inside the circle or outside the triangle, I am going to say something, not this one, right? Something that will affect financial statement as a whole, and those are called financial statement level risk. So again, whatever in this red color, inside the rectangle, I am going to describe them as financial statement level risk. And please make a note. Now if you are making notes up to now, this is note number. So I have lost track of notes. So we covered note 1 as risk of misstatement and note 2 as assertion. Here 2 is there, and I think we had another note. Probably let's say that is note 3, and I am sure you would have made it. And let me to say this is here note 3, we found it, right? Note 3. And now I want you to write note 4. And these are all examinable notes. What is note 4? The note 4 is to explain what financial statement risk. Well, I am writing here a few examples, right, inside this, which will affect not one assertion but many assertions. Now what is the example that I gave you? Managing director is coming, forget your accounting, I want every invoice to be booked, and that is called one of the biggest, most dangerous risks in a company that can happen. And I want you to definitely remember this. That's called management override, bypass, management override of control. The big issue. If there is a company, governance is weak. Now I am stressing that word governance. Now governance also going to connect to this picture. If governance is weak, and that is going to be, you know, some people dominate and say, managing director comes and say, forget accounting control and you do what I want. So that is called management bypass control. So that When that happens, you don't know what assertion will go wrong. Tomorrow, managing director will come and say, no impairment here. Don't do any of that. I will give a call to audit partner. Right? Don't do any of those. So now management override of control means anything can go wrong. Another thing where anything can go wrong is you are working for a company as an accountant where integrity and ethics are in question. Integrity and ethics. Right? Integrity and ethics. And I will give you a third example which can affect any balance is that you are working for a company, no qualified accountant. Management competence is in question. And I will put another big thing where accounts can be affected overall is going concern. Now I have 4 examples here. Going concern, right? So I will circle this in a different color so that you will make management override of control, integrity and ethics, management competence. If you haven't written, I am reading that again, going concern. So your diagram may be much clear than my one. I am giving you a lot of explanation and allowing you to write down this, right? So what I completed now, please write this. Now you have to write what is financial statement risk. Now you can write these two. If you want, you can draw it like this. Risk of misstatement. There are 2 types. One is assertion level risk. That you can explain by way of inherent risk and control risk that you understand. The other one is we can identify financial statement level risk. So please write now. Financial statement level risk means those risks that can have a pervasive impact. That word is very important. I will write here. Pervasive impact. Not account specific, right? With many account balance, pervasive impact. As a result, many account balances can be misstated, not one, many. So I underline 2 words. Pervasive means many. Assertion means 1 or 2. Now when managing director is corrupted person, you know, anything can go wrong. Tomorrow, today he will come and tell to do something unethical, right? So that is the big point that you learn now. And also, now we are able to see what is this. Still I didn't tell you what is number 1 here, what that circle means. I will erase this now because I explained to you a financial statement level risk. Giving this example, management override of control means many assertion can be affected. Integrity and ethical value means same. Management competence in question means anything, especially management competence is not there means if there is no qualified accountant in your balance sheet. For example, financial instrument which is complex may not be properly valued, properly accounted for because management competence is not there, right? So going concern is a separate matter. It's nothing to do with ethics or anything, but it can have overall impact because going concern doesn't mean one account balance. The overall financial statement can be affected. So now you will wonder what this circle means. The circle means, I said I will write 5 things and now number 2 is there. Number 2, as a CFO, how are you going to identify risk? Number 3 is if there is a risk, what is the internal control in terms of segregation of duty, reconciliation, authorization, and IT control also we can put here, additional one. Information system control. And that we covered here, that is also protecting because see what I have taken as a sub circle is the same part of this. This is, although this is a separately drawn, it is a part of the same financial statements, right? And then we also learn the definition of control risk. Again, you can go to the study text and read what control risk means. It should be given. If not, control risk means the risk that, right, if you can write down that, control risk means the risk that internal control will not prevent, detect, correct misstatements in financial statements. Right now, we have 3 things out of the 5. And not only 3, we have 4 things, right? So we need to find another 2. Missing person, missing 2 people we have to find in this. So one Remember, most prominent thing, if you analyze corporate failures, was it due to the qualification of accountants? Accountant was not competent, or anything to do with a particular accounting standard, or is it to do with the overall culture of the entity, the board of directors' attitude, awareness, actions, things like that, the integrity and ethics? Now see, it goes with these words. Were there corrupted people or true leaders in the business? That overarching things in internal control is number one. That number one is a very examinable topic, and I am writing the full word here, control environment. And whenever you say control environment, please write the word tone at the top, right? So overall idea is that, now you please write it because I don't write here. You can write control environment means you don't explain any account, no account balances here. Control environment definition start with control environment means governance and management. Both, governance means board, management means management like CFO, governance and board attitude, awareness and action. See, AAA, attitude, awareness and action regarding internal controls and their importance. In simple word, are you working for a company where the board and CFO, they are much concerned about internal control? They want to implement new system, recruit talented accountants and to fire anybody who is doing unethical things. That is a company where there is good governance. So therefore, I write these words because I put the word GACA, it's easy for you to understand. And A here, I mean, you can say there are 3 A's here, right? Let's take accountability, and under C I am writing the word culture. And remember, when I say culture, I can't write culture without talking about 2 things, integrity and ethical values of the business. And there is another A, that is, I will say, authority. Not I will say, this is what is there in auditing standard, the latest auditing standard, the same terminology, but then if you are using any different study text or whatever, it is the same thing. Don't just carry it away with saying, no, another book there is another word. No, this is the latest standard 315 revised. But if you look at even study text note or any other note, you can still categorize under same heading with slight changes, authority and responsibility. But if you are a good student, you must know what is the difference, authority, responsibility, what is actually accountability, I don't know, then you don't know. But you have to know authority and responsibility. And then finally, another A, that is people. You know, without people you can't run any system. That is attract and retain talents. So this is control environment. So that is the foundation of internal control. Now before I finish my explanation, I am going to write here something again very, very powerful and prominent, which you must know and which I will explain in my slides in few minutes. So remember, governance here means about the board. We'll use another color. You can also write some sub point. Governance is to say whether board of directors are actually independent. We are talking about accounts. Say audit committee, for example. Are they independent? Are they challenging the management? Are they exercising oversight? Oversight means, oversight also has a meaning called mistake. This oversight is not a mistake. Supervise. At board meeting where the audit committee is challenging CFO's account set and saying you can't value, you know, investment property in this way, audit committee chair is challenging, directors are challenging, right? So that challenge is governance here. So if there is control environment, that is number 1 criteria to ensure financial statements are proper. The chances of RMM are reduced. Now let's see what are the 5. 1 is here control environment. 2 is the risk assessment. If there is good board of directors, good culture, accountability is taking ownership, the authority, responsibility, delegation clearly defined. There are good people in such a company. CFO is identifying all the risks that can affect the accounts, and then CFO is building this circle, that is control activity number 3 to reduce the risk. Then number 4 is that accounts are coming out from a fantastic ERP system where there are segregation of duties, ITGC like access controls, backups, everything is controlled, the environment is good, application controls are good, everything is good. Then I will also write, so I had to find another color, right? So I have another color, green, to write 5th one. So I will put something, another kind of dotted circle going around all of this, and that is to check whether you are in check, meaning that somebody in the organization is monitoring that. You know, there are no culprit at the board level, but many companies can't challenge the board. Board is the board. But you know, there are some companies, this part even can challenge the board, right? Not every company. Then who is this green party, right? What it is? So there is some mechanism to check whether control environment is good. Risk assessment has covered all the risks, whether these controls are actually working. Somebody is checking that, somebody we call monitoring. But for your practical knowledge, remember, in organization, who monitors whether controls are there and working, and that is usually done by internal auditors. And then if you want to bring another circle, right, we can bring that also. I don't know what color I should use now, but let's say if you want to do another dotted circle like this, it's also good to have it, because remember, that is also part of governance, that we can say external auditing. So the now you can understand 5 things are covered now. So I have come to some milestone in my explanation. The 5 things, what did I cover? 5, let me to put it here. Now this is how I put it. Not I, this is a famous world recognized framework, and I write, you can also draw with me this separately in your diagram, and I don't tell you what the heading is. After drawing the diagram, we'll see what the heading is, right? I am writing 3 things on the top, and good student can easily understand what I am going to draw, right? When I say good student, I encourage all of you to be good students, up-to-date students, right, who are technically sound. And I am going to write 3 things here and 5 things here, and this is world famous. And whether you are accountant or CFO, anybody or board of director, this is important. 1, 2, 3, 4, 5. Is it 5? 1, 2, 3, 4, no? Right, 1. Okay, there I can write 5. And also I am putting here 17 here. Right, this is very sharp, right? 17. No 18, 17. What is it? If you look at every company, today I took the example of manufacturing stainless equipment and exporting. Now that company has to ensure their operations are smooth. Any company has to ensure there are 2 things in operation. Operations are effective. Number 2, if this company is a listed company, it's very important that whatever they report, that has to be accurate. So reporting. So I will say reliability of reporting, right? This is the second thing. What is the meaning of these 3 also, you should ask from you. The third one is to say any company, there is a regulatory framework. If you take a bank cannot operate without complying with laws and regulation compliance. So then what are these 3? Any business, they have to run their operation effectively and efficiently. They have to report right numbers. They have to comply with law. These are the objectives. Let's say this is a larger group. There is subsidiary 1, sorry, SBU. Let's say SBU. Strategic Business Unit 1, which is a banking business, Strategic Business Unit 2, which is a manufacturing arms, SBU 3, hotel, likewise, they have areas. Any of this business, if you want to drive this objective, start with good governance. That's control environment. I will use another color. Control environment on the top. And then, especially by talking about risk in reporting, risk in the business also, risk in operation, quality or what can go wrong, they have to have risk assessment process to identify what are the risks. No point of sleeping after identifying risks. Have control activities to mitigate this risk and to ensure the right information is coming out of information system and it is communicated across information and communication, right? 1, 2, 3, 4. Sorry, I have added additional one. The last one is to monitor whether this is working, and there are 17 principles. This is the world most famous internal control framework, COSO framework, and there are 17 principles, which is really new. Now we are back here after listening to that long explanation. Like I said, breaking financial statements into pieces, the risk of material misstatement, inherent risk, control risk, and then financial statement level risk, assertion risk, all that jargon. So technical words, terms, terminology that you learned, and now test whether you actually learned. And that is one of the thing that I always emphasize, distilled version. Now see, with the time that you are watching a video, that this distilled learning has to be instilled in your mind. So did you learn this? RMM, right? Now here, earlier my explanation is to cover RMM is more from a financial reporting angle. Now we may want to look at RMM now is from audit risk angle, which I will explain to you in during next 2-3 minutes. So but we learn RMM in much detail, especially these two, inherent and control risk, and also you learn assertion versus financial statement risk. 5 components of internal control begin with control environment, that is the governance aspect of it, and then the risk assessment, control activities, information and communication, and then monitoring. Those 5 you learn, and in the exam, control environment is a highly examinable topic. So another thing which I will cover use in a case study in my next session is to know the connection between business and business risk and risk of material misstatement, control environment I just mentioned to you. Then also in my explanation earlier that I covered, right now at the start I mentioned that the first choice in FAP, what is FAP? Further audit procedures. So before auditor is going to design auditor's own procedures, auditor will see how well company has designed the control, implemented, and whether control is operating effectively. So this is what we learn. But like I said, I want to give you the big picture of audit risk now, extend in RMM so that you understand that in full. So this is the explanation that I want to give you. Now if you take audit risk now, so here I am writing a topic called audit risk. You can go to your study text and see the heading audit risk, and you can divide audit risk into 2. One is risk of material misstatement, the other one is detection risk. Now this is very important again for you to understand in a more practical way, so that any exam case study you see the bigger picture of it. So in any case study, your idea is to identify what are the inherent risks, and then when there are inherent risks, we said there are controls, and when those controls are failing, we said there is another risk, and that is control risk, right? Then if I ask the question, what is the difference between risk of material misstatement and detection risk? If you are very sharp, only you can answer. So remember, risk of material misstatement means whose risk? Company's risk. it is the business, right? It's not only business risk, because you know business risk is something that will increase the inherent risk. But my point is, RMM is the risk of the company, right? If you think there is a company where property, plant and equipment impairment risk is high, that's the valuation assertion, impairment, right? So then you will see inherent risk is high, IR is high. And in this company, nobody cares about impairment. There is no impairment review done, there is no value in use calculation, audit committee has not checked, nobody cares about it. Which means there are no control scenarios. So then obviously we can't rely on control, so both inherent risk and control risk are high. So my question to you, when both IR and CR are high, the detection risk should be high or low. Remember, detection risk is a concept that connects to audit planning, right? And it is up to auditor to make it low or high. If RMM is high, the detection risk has to be low, because you have to understand detection risk means here the chances of misstatements are high, impairment. The company's controls are failing, therefore risk is there. The only party who can detect saying that property, plant and equipment is overstated by 5 million is the auditor. Detection risk means auditor also fails to detect. The meaning of detection risk is auditor fails to detect. Now whether auditor fails or not is auditor has some choice. If the audit is properly planned, with set of expert experienced auditors, they will do lot of hard work. When I say hard work, they are not testing control, they will do lot of testing by auditors, auditors themselves, that we call substantive procedure, and detect this misstatement in PP. So what I am trying to say, when RMM is high, the detection risk has to be low. Detection risk should be low, right? Lower detection risk means you are planning the audit, your further audit procedures you are planning in such a manner that you now don't rely much on test of control, instead you do lot of substantive procedures, right? You will, if this is property, plant and equipment, you may want to do your own analytical procedures and your own recomputation of possible impairment losses and all of that, and then you will detect there is a 10 million overstatement. Now you see how audit risk model connects to how risk of material misstatement connects to audit risk. And now as additional thing, I can also show you using a different color, these are auditing standard, right? For example, the process of risk of material misstatement identification is auditing standard number 315. That is where auditor understand the entity, and from the understanding identify inherent and control risk, and then after identifying risk like impairment here, auditor will plan and perform further audit procedures, FAP, and that is another auditing standard, that is auditing standard number 330. Right, so auditor will plan to detect, and then these two are broadly covered in auditing standard number 300, which is planning. And usually planning and audit means two things. One is the plan itself. The plan itself means your risk and the response. And remember, before auditor is going, this is usually at account balance level or transaction level. But there is much bigger part of audit plan before risk or response, and that bigger part is called, I will write it here, that is called overall audit strategy, OAS. So remember these terms, note these terms. Now if you are getting ready for the exam, if there is an exam question, developed an overall audit strategy, there you don't need to necessarily talk about individual account balances risk, but at high level to tell audit partner is directing the team that you do the audit and this is going to be your scope of the audit, and these are the areas of high risk: direction, and I want you to do interim audit and do some final audit, scoping, direction, timing and resourcing. Now these big ticket items where audit partner is guiding, audit manager and partner, they are guiding audit team to see, to scope out that this is the entity that you are auditing: scoping, direction, timing, resources. I'll take a mini case study and explain this to you. But now in this slide, now from my previous explanation which I did on the whiteboard and to here, the main difference where audit risk has two components: RMM, detection risk. So to reduce the detection risk, audit has to plan further audit procedures properly. In this example that I gave you, impairment, the control reliance is slow, more substantive work. Then I also said that audit planning, remember this point if you miss it, again I am repeating, audit planning means two things. One is to have the plan, right, where you have the risk and response, but even before this you will have the bigger part which is OAS. So in my next explanation I will cover this separately. What are the two things? What's the difference between overall audit strategy, which is the bigger part, that is you are talking about overall company, how as the audit firm should approach the audit, that's called OAS, overall audit strategy, which has these elements: scoping, direction, timing, resourcing. If you didn't understand, don't worry, I'm taking a scenario. And the second part of audit planning is the plan itself, where for each account balance you know what the risk is and what the response is going to be, and that is a kind of explanation on the audit audit risk model. And now I will take this case study now itself, and I can give you actually two case studies I am going to do in my next video. One is, if you really learn during this more than 1 hour session, that you conceptually understood the importance of all of this: the risk, assertions, internal control system, control environment. That I'm going to do at least 2-3 case studies to really see how to write an answer and how to analyze a case study, and that's what we are going to do in our next video. Thank you.